Hi everyone, welcome to Global Wealth Advisors 2023 Q1 Outlook. My name is Keith Sprauer, Chief Investment Officer here at GWA. I don't think I'm alone in saying that from a financial market standpoint, I'm glad that 2022 is behind us. And even though a lot of the same themes are in place, we have moved through some of these unknowns and are now looking at factors that we feel will be driving the markets in 2023. Certain items and issues are moving the markets and driving the economic outlooks. And the list you see here isn't necessarily in order of importance, but I think you can make a case that it's pretty close. One thing that hasn't changed is the importance of the inflation data, and we'll see that it has been a driver of Fed policy, consumer spending habits, and some responsibility regarding the position we're in the labor markets. Before we dive into where we are and what we're thinking, moving through the first few quarters of the year, we should take a look at how we ended up the year. A constant in our outlooks has been the performance quilt for various asset classes. And as you can see for 2022, the markets didn't finish out strong. If you focus on the third column from the right, you can see the full year 2022 performance. As we have seen, due to the war in Ukraine, underinvestment in fossil fuels and supply chain issues for most of the year, commodities have seen demand pressures that have kept the asset class in double-digit positive territory. The only other positive performing asset class from the one shown here at least is cash. The drop-off is substantial from there, ranging from about down 13% for fixed income to down about 25% for the year in the broad real estate trust category. As we've discussed, the main culprit for this performance is global inflation. Our favorite estimate here in the US for inflation is the Consumer Price Index, CPI, and it has come down. We saw a peak in June of just over 9% in the top line number. In the most recent reading, had a headline year-over-year number of 6.5%. So if you think about it, the Fed's first hike was about 10 months ago, so the effects of what they've been doing are just making their way through the economy. The Fed has targets on where they want to see inflation end up before they feel comfortable, somewhere around 2% in their favorite inflation gauge, but we're nowhere near that at this point. Because we've been worried about inflation for so long, any move downwards gives investors and consumers hope that things are getting better. So you can see by this graph, which shows consumer confidence in blue and inflation expectations in yellow, that these two are inversely related. You can clearly see it when the pandemic began in 2020. We see inflation spike substantially while confidence drops substantially. Now, some of that drop in confidence is of course due to the pandemic itself, but you can see the pattern repeat over and over. And as consumers get more confident, as a rule, they will spend more. So what did the Federal Reserve actually do in 2022? This chart is showing us what rate moves the Fed has enacted for the past 20 years, as well as showing us projections of where the Fed funds rate is expected to end up for this cycle, which is known as the terminal Fed funds rate. You can see the black line showing the move was straight up in 2022, going from a Fed funds target range of 0 to 25 basis points or 0.25% to a range of 4.25 to 4.5, which brings the rate to the highest level in 15 years. As you can see by the Fed's own estimates, which is the blue dotted line, they will be continuing up until they get to a range of 5 to 5.25%. And that means to expect hikes of another 75 basis points, 0.75% or so. This has changed slightly in the past week, with multiple Fed officials saying that they think a 25 basis point hike in February is what they should do. And the futures market is pricing this in to about a 94% chance. And that would change the terminal Fed funds rate from that 5 and 5.25-ish range to about 4 7/8. But this has been the pattern. The market expects the Fed to stop sooner than they're saying, and then the Fed comes out and dissuades that thinking, and the stock market drops and interest rates go up. So I think a key ingredient to this graph are the green projections. This is what the market is expecting the Fed to do. In the market's mind, the Fed will stop after one more hike of 25 basis points, and this could set the market up for more disappointment if it doesn't happen. And that disappointment would manifest itself in higher interest rates and lower stock prices. As a natural bias, we tend to focus on the US in both news and outlook, and in our portfolios, frankly. But it's imperative to know what other central banks are doing. And when a large percentage of central banks are doing the same thing, in our current environment, that would be raising rates, markets will react a certain way. As a rule, if global central banks are all raising rates, markets are going to do poorly. And if they're all cutting rates, markets will do well. And this is an interesting graphic that shows just that. All the central banks, meaning the big ones, US, UK, Eurozone, and so on, are all hiking, and it looks to be about 90% of global central banks are hiking. And if you think about it, you would expect that with many countries trying to slow inflation, it's going to work to a certain extent. And we certainly saw this when we look at performance for 2022. US large cap equities down 18%. International equities down 14%. Emerging market equities down almost 20%. The other interesting point to make is that when global central bankers are cutting rates, the markets do well. And it appears to be asymmetric in that you get much better upside performance when central banks are cutting rates. And maybe that's something we'll start to see towards the end of 2023 and into 2024. In times like these, one goal of the Federal Reserve is to constrict the economy and slow it to bring down inflation, and they do this by bringing down demand. And they do that by making borrowing more difficult and more costly through higher interest rates. So instead of putting money into the economy, they are removing money from the economy. And this graph shows not the overall level of money in the economy, but the growth rate of the money supply. And you can clearly see from the far right portion of the graph that the growth rate of money supply has slowed substantially to the point of contracting. A very important point that also has knock-on effects is where personal savings are. If you think about it broadly, when you have money in the bank, you may be more willing to spend, which keeps the economy moving. But if interest rates are high and inflation has caused prices to increase, you may have to use that savings just to keep up the same standard of living that you're used to. By looking at this graph, you can see on the right that the savings rate spiked when we were in COVID lockdown, which makes sense, no big purchases, no trips, but we've moved past that, and now we are at a suboptimal savings rate. We can see the effect of very low savings rate very clearly when we look at credit card balances. Not surprisingly, one of the effects of not having savings and having to pay more for goods and services is that people need to use their credit cards more and are carrying a balance on them when interest rates are high. As a rule, when credit card debt increases, you will see an increase in credit card payment delinquencies, which you can see by these side-by-side graphs on the slide, which show credit card balances on the left and credit card delinquencies on the right. And the overarching point here is that these types of trends can affect consumer spending and consumer confidence, which both need to be at a reasonable level in order to have a healthy and growing economy. As we've spoken about in the past, housing is a very big factor in the U.S. economy. And what had been more about regional pockets of weakness in the housing market has moved to a more general slowing in housing. And as you can see from this slide, which shows the monthly decline in existing home sales, that we've hit 10 months in a row now of monthly declines. And as we showed last quarter, with mortgage rates going from somewhere around 3% at the beginning of the year to a peak of 7%, it hasn't caused buyers to want to pay up for houses. And we're seeing price adjustments lower on a regular basis for homes that have been on the market for any length of time. Big indicator of where we are in housing is sales on more expensive homes. Historically, these houses have had stickier pricing and demand. In economic terms, we'd say that they're inelastic. But as you can see in these two time periods, the darker line which represents home sales with prices over 500,000, have started to slow as well, and are now moving on the same path downwards as less expensive homes considered to be under 300,000. One of the remaining factors in a softening housing market is if the labor market gets worse. Housing really slows down when people are out of work. And recall that one of the main goals of the current Federal Reserve cycle is to allow the unemployment rate to drift up to help slow the overall demand. One of the issues that is allowing Fed policy to focus on only one of their mandates, in this case price stability, is the continued strength of the labor market. In order for the Fed to feel comfortable in their goal of bringing down demand through higher interest rates, they want to see the unemployment rate drift higher. They want to see unemployment claims move higher and for hourly earnings to drop. But you can see from this graph that the overall unemployment rate is very steady, and the last reading actually shows it dropping even more to 3.5%. Now, the next few slides are going to show us a few important things. One is the expected path of leading economic indicators, as well as the expected path of earnings. And the thought here is that once the current focus or obsession on Federal Reserve policy has shifted away, it'll need to move back towards fundamentals, and in particular earnings. And what we're seeing here is a decline in leading economic indicators known as LEI, which is a composite index put out by the Conference Board, and it tends to lead economic downturns and upturns. We've seen this number decline steadily since its recent peak in February. This data is as of the end of November, so it's showing 9 months in a row of decline. And as you can see from the gray areas here, which are recessionary times, each substantial decline in LEI has resulted in a recession. Now, admittedly, the unknowns, which are important, are how deep and how long of a recession we may have. Now, you can combine those indicator declines that we were just looking at with the consensus that we're going to see global earnings decline in 2023. And it's hard to make a case against this when borrowing rates are so high for companies. More and more companies are relaying news about layoffs. It's expected that GDP for the year will only be slightly positive, and that consumers will likely slow down in their demand, particularly if labor worsens. So here we're looking at global projections for 2023 earnings. Certainly declining, but I would reflect on the fact that it was only mid-2021 where we saw large earnings growth as a percentage, with many estimates of this year of earnings growth being between 0 and 5%, depending on where on the globe you're focusing. I think a very interesting place to look at is where the people running the companies feel they will be going forward. You can see on the far right of this graph that here in the US, CEO confidence has dropped substantially, and that's that blue line, with the orange line being the earnings per share forward expectation. For this graph to be showing that decline, these CEOs have to be seeing something in the landscape that they find very troubling. Last thing I want to touch on is the international markets. There's been a great deal of conversation around the international markets over the last 6 months or so. And the conversations have been very much like the conversations around owning growth versus value, and when each may take the lead in performance. So a similar conversation has been happening around US stocks versus international stocks, as measured here performance-wise on this graph by the MSCI indices, which are the Morgan Stanley Capital International indices. And we've discussed in the past that when you look at equities globally, it's loosely 50% in the US and 50% outside of the US. And of course, there are multinationals that confuse the data a bit, but in general, it's 50-50. And you can see from this graph that outperformance has come from the US for the past 15 plus years, basically since the great financial crisis in 07 and 08. So it's very natural to look at valuations today and say there is value in international compared to the US. And as international equities and companies start to get through some of the hurdles that they have, and some of these hurdles are starting to fall away, things like issues with supply chains, extreme energy pricing. Hopefully there will be a resolution at some point this year to the war in the Ukraine. These countries could see substantial performance growth. So we are in the camp that it's important to have international exposure, particularly at this time in the markets in all the portfolios. So far, we've spoken more about the possible issues we're facing than about good things that are happening. And on this headwinds and tailwinds slide, we can see some of the tailwinds that we should be getting. Exactly when and how much will be something of a larger question for the year. I would expect that when the Fed is done hiking and they signal a pivot, it'll be a great relief for the markets. China is a large key to a functioning global economy. If in fact they can reopen by moving away from their zero COVID policy, we should see their imports increase, which tends to mean cheaper imports for us and a smoothing of our demand for goods, bringing down inflation. And although we may see issues with earnings and slow economic growth, we are beginning the year at much better valuations in almost all asset classes than we were just 12 months ago. So all the data that we're going to see over the quarter will be very important. But I feel the key focus at this point will be earnings, where they come out versus estimates, what the guidance is going to be provided by the companies. If they don't come close to expectations, we're going to be in for a rocky few quarters going forward. From all of us here at Global Wealth Advisors, thanks for watching, and I'll speak with you next quarter.